Jesse Sigrist.
What?
Excited to see this.
Yeah,
I'm
looking
excited
forward
for
to it.
this episode. Yeah. So this episode's going to be a little bit different. This episode, we do have a guest on this episode, but it's Jesse. So this is a little different. We're going to talk about investing today. We are not going to give financial advice, but we are going to talk about what are kind of the fundamentals around investing and provide some education towards that. Jesse has a bachelor's degree that is CFP board certified. CFP is the Certified Financial Planning or Planner.
Planner.
And he is working towards his CFP completion. And while doing that, he's working in wealth management in Portland and studying for the CFP exam. And also, Jess is a host of this podcast, Becoming Ourselves.
Yeah, you all know me pretty well at this point, but
That's right.
we thought it'd be kind of fun to play into the fact that Joel and I both have some individual expertise, and that can be relevant. And so thought it would be kind of fun to play into that a little bit, lean into it.
100%. And for this episode, we're playing into Jesse's strengths.
Yes.
Investing. So, Jesse, we're going to start off really high level, and then we'll drill down a little bit from there. So, investing as a concept. Investopedia talks about investing. It's different from trading. It's different from saving, and that investing is for the long term, usually years or decades. And it's one of the key strategies to building long-term wealth and financial security. Can you talk a little bit about what investing is and why people are interested in it, why it's such a big deal?
Yeah, absolutely. One of the things that I like to think about as a broad definition of an investment is something that is going to grow in value or appreciate in value, ideally. And so if I buy, a common example is like a house tends to appreciate in value. So that can be an investment. Education, me getting my education means that I'm able to make more money in the future. So that is my monetary value increasing.
Yeah, your earning potential
Yeah,
increases.
earning potential increasing. And so on a broad level, it's something that becomes more valuable over time. We can even take a step outside of money and say a relationship can be an investment, something that gets better over time. You have to pour into it, right? And so that's the flip side of an investment is you're often giving something up now. If you're buying an investment, you are losing money, quote unquote, now to be able to have something that's worth more money in the future at a certain time.
Yeah, long-term wealth and financial security.
Yeah. And so
Um,
there's a lot
Hosting
of,
a podcast could be an investment.
it could be, right? We're hoping. And so it's a pretty integral part of financial success because you often want to retire at some point or you want to have money to purchase a house, purchase a car, and if you can make your money grow and become more valuable than it is now, well, and invest like that's less work for you, right? That's a put your money to work, right? Your money is working for
Totally.
you on your behalf, which is a really nice thing
Yeah,
when done effectively and everything.
I love it. So there's two kind of main ways that people generally talk about investing, right? I mean, there's Forex and other things that we're not going to get into on this podcast. But the two main things are stocks and bonds. Can you talk a little bit about what are stocks and bonds? What is the stock market? Just kind of a high level, take 2 minutes.
Yeah. So a stock is ownership of a company that is quote unquote publicly traded. So those are often companies we've heard of: Apple, Tesla, Nike, Facebook. There are, I should look up the exact number, dub in exact number. There's thousands of publicly traded companies. There also are non-publicly traded companies that it's not nearly as easy to acquire ownership of. But a stock is where you buy part of the company. You are an owner. A stock is a portion of a company, right?
It's a piece of it.
Yeah. Um,
The New York Stock Exchange has more than 2,300 companies listed domestically and internationally as of May of this year.
That's a lot. Yeah. And I think there's
The
other
Nas
exchanges that
the
have
Nasdaq has
more.
3,600.
Right.
Yeah.
So there's a ton. But that's why a stock is valuable, is because you are a partial owner. If you buy a stock, you are a partial owner of a company. And if that company has repeated success, long-term success, well, that company is worth more. When you bought in and you own part of that, well, that piece of ownership is worth more. So that's how a
Yeah.
stock grows in value. A bond is a little bit different. It is lending money, so you are giving money to a company in exchange for them guaranteeing to pay you back that plus something. So that's a little bit more like what the flip side is what we do with banks often. If we get a mortgage, a bank is saying, hey, I'll give you $500,000 in exchange for you paying me back month by month that $500,000 plus X percent interest. Bonds are just the flip side, right? I mean, bonds are super broad category, but I think about it as an investor. I think about bonds being the flip side, where I'm saying, okay, Apple, I'm going to give you money because you need it, right?
Mhm.
I'm going to give you money now in exchange for you giving me that plus a little bit more and
Plus
then
interest over
yeah,
time. Yeah.
and over a certain period of time. So a couple of things about bonds: there are there are different time frames that you can buy a bond for. You can buy bonds that are like within a year time frame, even shorter with the government. It can be like daily or weekly. I can't remember what the shortest amount is. And those are going to be I pay you $1, you pay me back $1 and 0.0000001 cents, right? You're not getting a ton of return, but it's also in a day, right? So you're not taking on very much risk. Um, you're not really losing out on a ton there.
Yeah.
Then you can buy bonds typically all the way up to 30 years, which is saying like over the next 30 years you're going to pay me back little by little by little by little by little. Ideally, you're getting compensated for that. So if I'm not getting this money back for 30 years, I want a little bit higher return. That's not always how the economy plays out, but that's the ideal, right?
Yeah, there's a lot
For
of ideals in the
Mhm.
economy that aren't actually the way that it always lives out. There's
Right.
especially thinking about the stock market that like in theory, the stock market you're buying pieces of companies and then the better the company does, the more your stock is worth. In reality, news plays a lot into it, announcements plays a lot into it, public perception plays a lot into it, the SEC plays a lot into
Mhm.
it. And so it's not as simple as good companies go up, bad companies go down. There is a lot. That's the ideal, but it is a lot more complicated than in practice.
Yeah, absolutely. And I think a qualifier too is those are really felt in the short term. So if I buy into this one company and then the next day the CEO makes a racist tweet, like that's probably going to go down. And that's honestly, that's probably indicative of maybe the company has some values that I don't agree with. Maybe I want to get out of there. And often what we'll see is a lot of people say, I want to get out of there. I don't want anything to do with this. They all sell. And then we actually get into just basic economics of more people selling this stock than buying this stock, it's worth less. That's just supply and
Yeah.
demand. This is not an economics episode, so I'll pump
This
the
is not.
brakes
This is
there.
not.
But we do tend to see tend again. These are general strokes. We do tend to see over the long term better companies have a little bit more success within their stock price, within their company valuation. Whereas, yeah, this week was bad on cars. This month there was negative news articles about this. It went down. But often over the longer term, those do even out, and there is more reward on quality. Although there are exceptions. There are always
Yeah.
exceptions.
Yeah, but you look at, I mean, Warren Buffett's example is like Coca-Cola, that he bought into Coca-Cola in like, I don't know, the 60s or something, or the 50s. And Coca-Cola is a productive company that sells consistently month over month, quarter over quarter, year over year. And so over the 70 years that Warren Buffett has owned Coca-Cola, it's gone up however many 1,000%, right? Because it's a well-run company. They're consistent earnings. They're very profitable, and they have been for I don't know, a century or however long Coca-Cola has existed, right? And so, in the big picture, I think good companies trend towards stock success.
Yeah, absolutely. And then the other side of that is one of the reasons like Warren Buffett's had so much success investing in Coca-Cola and so many of the other things he's bought is because he's done it with a long-term approach. And so he hasn't said, because I'm pretty sure there have been dips in Coca-Cola's stock price.
I would imagine.
I would imagine March of 2020 there was a pretty big dip in Coca-Cola stock price because everything, I mean, the whole stock market went way down because of the pandemic. Same thing in 2008. There was, there are these things that happen, and I'm gonna guess Warren Buffett did not sell out of these investments, even though his portfolio, his investment value looked way down at that point. And I mean, that's something that is an easy mistake to make, to say, "Oh, I looked at my investments; they're
Oh,
all
I did it.
down." Yeah, it's
Oh
really
yeah.
easy
Oh
to
yeah.
do, right?
It
It's
is.
really easy to be super reactionary there and say, "Well, everybody else is getting out. I don't want to be the sucker."
Right.
Um, but I mean, there's a lot of data that shows if you stay in, if you withhold that pain, I mean, it bounces back, and there's 140 years of evidence of that, right?
Yeah. So what is like we've got 140 years of data of the stock market, right? What are expected returns year over year for obviously it's different for every company, but if you think about if you're just tracking the S&P 500, right? The 500 most valuable companies in the stock market. What have they done?
So that's a simple and a really complicated question, and I know you have an answer in mind. Um,
Not necessarily. I've done some research, but I'd love
right.
to hear you talk about it.
Yeah, so I mean the common number we hear thrown around is that the S&P 500 has averaged a return of around 10% over the
There we go.
last.
That's the answer I was looking
All
for.
right, close the episode.
Cut. Thanks
Um,
everyone.
Practically, the S&P 500 is the 500 more or less biggest companies that are domestically traded in the United States. Um, they have had a lot of success. They have grown a lot. Um, they also tend to have some of the biggest fluctuations. And so when thinking about what I just talked about with like some investor psychology of when the market goes down and it's really easy to sell out of things, the S&P 500 has historically also been a place where people have sold out a little bit more
Oh,
because
interesting.
and so we'll often see it goes up 30% in a year, it goes down more strongly the next year, where other companies are maybe riding a little bit closer to the 0 to 10, 0 to 5 to negative 5. The S&P 500 has a bigger standard deviation often.
Yeah.
And so uh, that kind of, I mean, if you buy into the S&P 500, it's a good place to be. I have some money in the S&P 500. They're the famous companies, right? They're the ones we
Right.
we know of, we've heard of, and I'm not at all trying to bash on the S&P 500 here, but it also is typically the easiest number to tie to,
Mm,
and I do think there is a little bit of expectation setting that should be added there. Of if you are exclusively invested in the S&P 500, you're in for a little bit bumpier ride. It's a little bit more of a roller coaster. It is a roller coaster that maybe is more likely to land you at the top,
right.
but are you prepared to be strapped in, right? Whereas if you own some smaller companies, if you own foreign companies, if you own a more diverse set of companies, it might not end you at the very top the same way historically the S&P 500 has, but it'll be a lot easier to stomach often.
That
So,
makes sense. Yeah. Yeah. And I think like we've talked about a bunch on this podcast, like something like the investor psychology of it, like anything that you're actually going to be able to do and stick to and not panic about, not be worried about, like that's the best plan is the one that you're able to stick to. And like those big fluctuations, not everyone has a risk tolerance that wants to deal with large fluctuations, right? So it's not for everyone. Like this is not financial advice. Like, hey, do
Mhm.
your own research, make your own decisions. But that is interesting to note that there's a bigger standard deviation there.
Yeah, and absolutely you're right. It's like the best investment is the one that you're able to stay in, and like the best plan of action is the one you're able to stick to. And so, I mean, yeah, I think you said it as well as I could have there.
Yeah. Well, thank you. I appreciate that. Okay, so taking a step back from like the stock market, taking a step back from kind of where to put your money or that sort of thing. Um, how much money should someone be investing? Like thinking about, you get a paycheck that's X amount of dollars. How much of that should go into your investments?
Yeah, that's another great question that has a simple answer and a much more complicated answer. But
We're okay with the nuance here, buddy.
yeah, yeah. I mean, our favorite word in financial advising, wealth management, financial planning is it depends. um, it depends on how much debt you have. It depends on if you have an emergency fund. It depends on those are two of the really big factors. So I would say you kind of want to fill up your stability bucket first, and you want to have an
That'd be the
emergency
emergency.
fund. Yeah, so you want to have an emergency fund built out. That's typically looked at as 6 months of expenses is a good spot to land there. You can go up to a year. I know of people who go up to 2 years. I know of people who have 0 years. That's a lot more stressful for me. That's a lot more risky, right? You're taking on a lot more risk there. And I want to acknowledge it's hard to build up an emergency fund.
Yeah.
And it's hard, like I'm talking about this as if it's really simple. Like it is not an easy thing. It's a task that requires discipline, and it requires a lot of hard work.
Well,
But
and if you're thinking 6 months of expenses, like it could be $20,000, $30,000 depending on your lifestyle, right? Easy.
yeah, yeah,
Yeah.
definitely. And
Yeah.
so there's not just like a dollar value. Some people are really frugal. Some people are a lot more lavish, and it depends. But once you've built out uh, an emergency fund, then we can really start looking into like how much do we want to be investing, how much do we want to be saving for other reasons, and again, that kind of depends on what your goals are with your investments. I think most people have a goal of like I want to retire, um, but some people really want to retire as soon as possible, and it's if it's we kind of think a standard age for retirement is 65. Some people want to retire at 60. Some people there's the fire movement right now among millennials,
Oh,
financial
financially and
independence, retire early,
yeah.
and that's often looking at trying to retire at 45 or 50 or maybe even younger. So that's going to be a completely different
Your
equation.
goals are way different.
Yeah.
Yeah.
And so it's pretty much impossible to compare somebody who's like, I would be really content working till 70, 72, compared to somebody who's like, I would love to stop working at 40. That's a
Yeah.
32-year difference, and your money has to be doing different things for you in that space. But um, I like there's people who kind of recommend like if you're able to invest once you've got your emergency fund, if you're able to put 25% of your paycheck into long-term investments, it's something that you probably won't regret. It's hard. You
Yeah.
you feel like a lot of that paycheck is not there for you, right? You aren't able to enjoy it. That said, you are able to enjoy it when you're retired later in life.
Yeah.
And so if you're able to set up that discipline, especially early, that money can go to work for you for a long time. But again, it's hard to part with 25%
Yeah.
of your money, right?
That's a
Right away.
quarter of it, right? That's a
Yeah,
big
that's
chunk.
that's a quarter of it. And one thing that can be helpful is think about like you are paying yourself there. So you are the beneficiary of that, right? You are just paying yourself in um, 30, 40 years, not unlike eating well, like we talked about in different episodes,
Last week's episode with
last week's
Elena, yeah.
episode, yeah, where you're saying maybe it doesn't taste as good right now, but tomorrow I'll feel better, or in a month I'll feel better.
Yep.
Investing isn't a ton different from that, where I'm saying maybe it's hard right now to part with this money, but I'm paying myself
Yep.
and I'm really going to appreciate this when I'm 60. I would even argue I'm really going to appreciate this when I'm 50, 40, and 30 because that means I'm able to see a clearer future. And so maybe at 22, it's easy to not be as often thinking about like, when I'm 65, I'll be fine. I don't have to worry about that. But
Yep.
it's pretty common to hear people say at 35, 40, looking at like, I want to retire, but I don't have anything saved. I don't have anything invested. And that's a
Yeah.
lot harder situation to land in and to set yourself up for the long term success there.
Yeah. No,
Now,
it is.
so that's an ideal. I can point to a lot of resources that hope for that, right? Something I really
And
like.
we'll have more resources in the description of this too. So more reading and more notes and things that you can jump to.
Yeah, something else I really like is a lot of like retirement plans, and we'll get a little bit more into like retirement plans later, but they have this button that says increase my contribution by 1% each year. And so I love that button. I am not going to recommend very many things on this podcast as far as financial advice, but I think that button is one of the best things that
Oh, interesting.
exists because maybe you start out putting just 3%. Maybe you start out putting 7% or 10% of your money into this long-term investment. But then next year it goes up. So 3% becomes 4%, 4% becomes 5%. It feels like a small dollar value, and it looks like small dollar value, right? Maybe it's not a huge increase, but it's consistent, and that's every single paycheck or every single month that it's a little bit higher, and that's a place that can help you get to that 25% without it being a really abrupt change, and so it can be a little bit more palatable depending on where you're at right now. Um,
I like it.
so
I like it.
yeah.
That kind of does two things also that I think are interesting. And we were planning to get into these later, but we're just going to get into them now. One of those is the idea of compound interest, right? And compound interest is something that is fairly well documented in the world, right? And, some people call it the eighth wonder of the world. I think Warren Buffett has called it that. And like people talk about it in different ways. It's a powerful math tool, right? Our brains don't work in a compounding way. Our brains can add and multiply and divide, and that's
We,
about
we
all
don't
our
work
brain.
with exponents, right?
Our brains do not work with exponents. And so seeing when your interest is gaining interest,
Mhm.
like that's a very powerful tool. And that starts when you're young. Um, and the other thing is time cost averaging. So I would love to hear you talk about compound interest a little bit, and then also the time cost averaging idea of being able to put that money aside every month and being able to like get that in, um, all that.
Yeah, absolutely. So compound interest. I first learned about compound interest when I was 7, I think, and it kind of
Thanks, Dad.
like yeah. Actually, mom explained it to me,
Oh, okay.
but I'll give a pretty quick definition on it. It's like if you have $10 and then you're getting paid 10% interest on that. Um, well, let's say $100. Easy math, right?
Yep.
$100, 10% interest. After 1 year, you're at $110, right? Well, then if you keep all that money in there and you're getting 10% interest on that, you've still put in $100, but you're getting 10% interest, so you make what, $11 the next year. Um, and so then you've got $121. Well, then you make 10% on that, and what's 12.1? So that's even more and even more and even more. And if you keep letting that grow in that way, well, you've still just put in this smaller amount of 100, but now you're getting 10% interest on 145 or 180, And I mean, when that starts growing closer to 1 million and you're still getting 8 or 10 or 12% or even 5%, that's growing huge dollar amounts for you
Yeah.
and can just be so beneficial. And I mean, it's not unheard of to see your investments at a certain point start growing at a faster rate than the money you earn, like as a salary.
Interesting.
And so, I mean, you can think about that. If you have $2 million invested and you get a 10% return on that, that's $200,000.
Yeah.
It's not a ton of jobs that pay $200,000 in a year, right?
No. No.
Now, obviously, that's complicated. There's tax things that come into play there. There's all sorts of stuff, and
Yeah.
also your investments can go down. And again, I tend to believe they'll go back up. It's good to
Yeah.
stay in it, right? But that's a really cool idea. Like
So
that to me is,
I want to
yeah, yeah,
butt in a little bit. So $2 million. It's a
yeah.
shit ton of money.
It is
It's a
so
lot of
money.
money to have $2 million invested. I do not have $2 million. Our analytics say that our listeners are between 18 and 34, the majority of them, between
Right.
18 and 34. A few of them are kids. Kids, great, start early. 18 to 34. Um, the majority of them do not have $2 million.
Yeah,
That's a shit ton of money.
it is.
How achievable is it for someone that makes a salary between $50,000 and $100,000 a year to actually end up getting to $2 million in their lifetime?
I mean, it's doable. It's absolutely doable. It depends on the behavior. It depends on the decisions that you make, right? Like it's not gonna happen automatically. There's steps you can take that will help you get there. Um, I'd say like start now, right? That's where investing can
Yeah.
really come into play and help. Is even if you're starting at small dollar amounts, traditionally we're hoping, especially these like us young adults listening to young adults talk on a podcast, right?
Right.
Um, we're hoping that our incomes go higher as well. We're hoping that we keep getting raises, and maybe we're making $50,000 right now. Maybe we're making 40 or 30 even thousand, or maybe we're unemployed. Shout out to my unemployed listeners. Like that's also a really real place to be, and that's hard. And I want to acknowledge like that does make this conversation sound daunting and not particularly welcoming. I want it to sound hopeful, right?
Yeah,
Um,
and like thinking, let's can we talk about the math for a second?
yeah, yeah.
Okay. So I have some of the math pulled up.
Hmm.
And so if we think about retirement age of 65,
Hmm.
right? You called that out as a target earlier. Obviously, like if you're trying to retire by 40, if you're trying to retire by 70 or 80, the numbers look different depending on, what your goals are. But if you are hoping to retire at 65, you're 25 years old now, 40 years. If you put away $180 a month at a 10% rate of return, you will reach $1 million by the time you hit 65. At $180 a month invested and getting a 10% rate of return, which, as we talked about, is not guaranteed. It's, you never know. There's some
Right, right,
big
right.
fluctuations,
And
nothing's
Joel,
guaranteed.
do
But
you have on that? Do you have on that sheet? Do you have on that page how much of that is money that you put in?
oh, it does not have that.
Okay. I don't have it pulled up right now, but often you see that will be depending on when you start,
Yeah.
like $200,000 or $300,000 of that $1 million is
Wow.
stuff you put away, and 800,000 is the work the money did on its own.
Yeah.
Um,
That's a
I
big
might come
amount.
in
That's
here
a big
after
amount.
and do the actual calculations on that, but
Yeah.
um,
We'll do the actual calculations. We'll just throw a spreadsheet up on the screen
yeah,
and people can see it and be able to look at the way that time value of money works.
Hmm.
And we can link in the description some documents to look at time
Yeah.
value of money, and
Yeah.
some calculators for
Hmm.
that, because it really is powerful. And again, thinking about having $2 million. $2 million sounds unattainable. Like $2 million sounds unattainable
Hmm.
to a lot of people, right? And especially people that like didn't grow up with people,
Yeah.
around people that
Yeah.
retired. Um, and so I just want to talk about how it is
It is
more
possible.
achievable
Yeah.
given the timeline,
Hmm.
given a 40-year
Hmm.
timeline. Like, again, a lot of our listeners are between 18 and 34. If you're 18 and you 47 years until you're 65 and you're trying to retire at 65,
Yeah.
the number is even lower. Like, it's less than $180 to get to $1 million.
Yeah.
Um,
Yeah. And there's another like concept called the rule of 72, which
mm,
is let me pull up the actual definition, but it's essentially how long it takes your money to double. Um,
oh, okay.
and it's like if you here's what Investopedia says. It's a quick and useful formula. I mean, it's a math thing. Um,
Yeah.
but shoot,
Man, y'all, we're doing it live.
we're doing it live. We're
Doing
trying, we're
it
trying.
live.
Um, so yeah, it's like here's it on an economic scale. It's like if your economy grows 4% annually, then your like the amount it takes to double is 72 divided by the growth rate, and then the output is years. So if it's 4% growth, it's 18 years. If it's,
Oh,
I think,
wow.
what is it, 8%, then it's 9 years, or 9%, it's eight
Yeah,
years.
8% would come. Yeah, both of those would be accurate.
So, I mean that's not that long. Like if you have, I mean, we're talking about this compound interest, this exponential growth, um,
Yeah.
10% growth. It's like 7.2 years to get your money to double, just on its own growth, right? And then you think about you're adding in money. If you're adding in money, then, well, that's just this keeps growing. The math starts to really work for us, and that's something that is so valuable in personal finance. It's like make the math work for you. The math isn't isn't gonna change. Um, Now, things that can change is like the rate of return, like that fluctuates a lot, but that's why it's important to stay disciplined because like these averages are nice. The fact of the matter is like there are years where it's down. 2022 was a year where the whole market was down. It was really hard, even for me. It was hard to keep my money and invested and see the little bit that I'd put away, like
Yeah.
as negative now. Like, what did I even do this for? I could have spent that money. I could have had fun with that money. And
Right.
then this year, 2023, has had a lot more successful market, and I've seen that bounce back, and like that feels really good. It feels really good to have been disciplined, stayed in, bought a little bit more, and realized like, okay, like I'm already seeing some returns on this, and
Yeah.
realizing, okay, I can withhold those down markets. You talked a little bit about time cost averaging. Also,
Oh, yeah.
another term with that for that would be dollar cost averaging. Essentially, that's one of our best defenses against the market fluctuating and our best ways to take advantage of it. And so the market is going to go the stock market, a stock price, right, is going to go up and down daily by the minute, honestly, within the hours that the market is open. That doesn't matter a ton, but the market is open up until 4 p.m. Eastern, so 1 p.m. Pacific
Yeah.
time. This is also, most of this is for our United States audience. um,
Yeah. Most of our listeners are in
Most
the
of our
US.
listeners are in the U.S., but just obviously. Uh, um, but while the market's open, like the stock prices are changing all the time,
Yeah.
and if the price goes down and you buy something, well, you bought it, say we've got a stock that sells for $100, and then you buy it, so you own it for $100. Then it goes down to $90. You have one share, it's now worth $90. You buy another share. One of those shares is worth 90, or they're both worth $90. You bought one of them for 90. You bought one of them for 100. Then they both go up to 110. You buy another share. Well, now you've bought three shares for an average of $100 a share. One of them, like, yeah, it went down for a little bit. At that point, you said, awesome. I got more because I'm putting $100. Let's say I'm putting $100 into this fund or into this stock or into the market a month, a week, a year, a day, whatever. Well,
Per time period.
per time period, right? I put $100 in, stock price went down. Instead of saying, oh no, my money, like my precious stock went down, I say, awesome, this $100, I'm getting a discount. I bought more of the stock. Then it goes up. I say, awesome, the stock I own went up in price or went up in value. I'm worth, my money's worth more now. And I buy again. Well, I got less in that purchase, but that's okay. Then it goes down again. I say, awesome. Then it goes up. I say, awesome. And I just keep putting money in. And that consistency is going to say, yeah, even though it went up and down and up and down and up and down, I got some things at a big discount. I've seen it grow a lot. Both ways
Yep.
are awesome. Like, I feel really good about either way there.
Yeah. Versus like if you did $100 a month for a year, right?
Mhm.
And you did that and you just put $100 into this account on the first of every month. Um, as opposed to taking $1,200, putting it on all at the same time. Well, if the stock is up a lot when you put it in, and then you put $1,200 into the stock, when it's $120 or $130, then that's what you buy them all at. And then
Mhm.
when it does come down to 110, 190, even 80 maybe, like you just are seeing big losses instead of
Yeah.
averaging that out and coming back to, okay, I bought it at the midpoint, which is time in the market beats timing market.
Yeah, absolutely. That's big wisdom right there. Um, just
I didn't
just
come up with that.
no, but get in the market early. The one of the nice things is like, especially as young people, but even throughout your working career, you almost automatically dollar cost average if you are like putting money away with each paycheck. Well, that's every 2 weeks or every week or every 4 weeks is the typical ways. And so if you're just putting away some of that into your retirement account, which again, we'll get into that in a little bit, that's great. Like you are the market's going to go up, the market's going to go down. But if you do that for your whole working career every 2 weeks for 40 some years, well, that's a lot of different times you've bought into things.
Yeah.
The times you maybe have to do this a bit more manually or would potentially benefit from that is like if you get a big bonus or if you get some sort of an inheritance or some sort of a large gift. Um, well, maybe it can be better to dollar cost average that if you want to invest it.
Yeah.
Um,
That makes sense.
but just the consistency and the long term approach can really help set up a long term investment success
Yep.
story.
Yeah. No, I like it. I like it. Okay. Well, let's pivot a little bit.
Mhm.
What are some of the platforms that just can you give a list of the platforms that people can invest on?
Yeah, I mean,
This doesn't have to be a comprehensive list,
right.
but
A lot of them are the ones most people have heard of, but like Vanguard, Fidelity, Schwab are three big ones. E Trade, um, Robinhood, Acorns are some of the apps that have done really good at marketing, but are a little
yeah.
bit newer.
Is there a benefit to using kind of the like long term, like a Vanguard or a Schwab, which has been around forever, versus something like Acorns or Robinhood?
I mean, there's a little bit of credibility that comes with having been around for a long time. There's also a little bit of, I mean, I tend to trust the longer ones a little bit more. because they have been around for a long time. I also think like Robinhood, not to pick on it too much, but it feels gamified.
Yeah,
It's
totally.
really good at saying like this is bright green, this is dark orange, and so if you have your Robinhood account and your portfolio is down for the day, everything is red and orange, and when it's up, everything's green and everything. And it feels like, oh, awesome, oh no, oh, awesome, oh no, and it encourages you to check your balance every day. Hey, I haven't seen you on Robinhood in a little while. Come back, buy more stocks. Great. Yeah, I mean it's often good to keep investing, keep doing that, but um, it can really incentivize you to when the market's down for a week or a month or a year, you're like,
Yeah.
well, it's been orange the whole time. This is not fun.
Mhm.
Whereas when it's green, like, awesome, 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 I'm going to buy in more, which, I mean, yes, like buying in more is good, but I think it can be a negative game with the investor psychology that we talked about earlier.
Yeah, thinking about trying to keep that long-term perspective and trying to be in it for the long term and not make kind of those gut reactions.
Hmm.
Robinhood kind of like the platform itself, the way it's designed, does encourage those gut reactions. It does encourage kind of um, quick responses to the market, which is not always the best.
Right. And so for it's like that's one of the reasons that I moved my money away from Robinhood was just because I was like, it's really easy to like want to do what I feel like it wants me to do.
Yeah.
Um, which I will say as a pro on Robinhood, it's been really good at getting young people to even think about investing in a way that I think the longer like Vanguard, Fidelity, like the longer running things weren't really trying to appeal to young
Yeah,
people.
some of the user interface on something like Vanguard or Schwab or Fidelity, those are such boring interfaces, right?
Right.
Like they don't really do much marketing. They're boring interfaces. They're like hard to navigate. Like,
Yeah,
why would
and
I want
like
to get into
I think
that?
they've gotten a little bit more interesting
Oh yeah,
recently, just as that's the current marketing trends. And I mean, I would say like on the whole that is better for behavior, but it's less entertaining, and so it's less inviting. Um, Long and short of it is like better one of them than none of them. Um, and then like yeah, it's there's certainly some pros and cons. Most of it is just usability and I mean trustability, right? Like do you
yeah.
trust where you're putting your money is a pretty big one. If you've never heard of it and then like some person on the internet says like, hey, here's the new big thing, probably not.
Yeah.
uh,
Just be wary of that.
just be really wary. And so
Yeah.
like the other thing is these big like long running institutions, they are highly regulated. They have massive cybersecurity and compliance regulations and things like that that I think adds a little bit of credence. Whereas if something has only been around for like 6 months, I mean, we just saw like with a lot of the crypto things,
Like FTX is a big
yeah,
example.
like, oh, it seemed like the next great big thing, but practically, I mean, it wasn't following all the rules and it wasn't quite as much engaging with the ways to keep people's money safe.
Yeah. Yeah.
So,
Okay, so should people be buying like should you pretty much only buy stocks that you've heard of, or like Nike, Tesla, Apple,
mhm.
Meta?
Yeah, yeah,
Meta is Facebook for those
right.
for those of you
Microsoft,
who've been living under a rock the last 2 years. Like,
like, um, short answer, no, don't only buy those. Um, they're always in the news, which makes you feel like
they
that's the
are.
only places to buy. That's another place to like, if you watch the news every day, it's not going to be as helpful for your investor, uh,
Yeah.
your individual investor psychology.
There's a lot of individual psychology that can kind of get warped by watching the news every day.
Yeah, definitely so. And
There's
there's
some
a
editorials getting in there. Don't watch the news every day.
yeah, yeah, and there's a lot of individual psychology that plays into investing. Like that's kind of a theme that I'm hitting pretty hard here because
Oh
I mean
yeah.
practically like the math is great on a spreadsheet. At the end of the day, it's not the math that has to press buy
The
or
behavior
press
does.
sell, right?
Yeah.
And so like you have to be able to be a little bit knowledgeable about that. In answer to your question, Joel, it's not bad to buy into stocks that you've heard of, but we do have a bias to do that more often than we should. More often it's beneficial for us. And the big reason why that is that this isn't even saying like Nike is a bad investment or Tesla or Facebook or Meta, whatever, are bad
Yeah.
investments, but it's saying that the this concept of diversification is like don't put all your eggs in one basket. And so if I only buy into Apple, I mean like Apple's a pretty effective company. They've had a long range of like they've changed the tech world. They've done a lot of really cool things. Um, and
Not
also
going anywhere.
if I only own Apple, I'm at the mercy of Apple's stock. And if I have all of my investment money in Apple and then Apple has a bad day, okay, fine. If I'm able to withstand that, that's whatever. If Apple has a bad month or bad year or like unlikely, but like goes out of business, like I can be in a lot of hurt there.
Yeah.
Um, and that's not where I want to be. So what I would prefer to be in is more diversification. And so if I even say I own 10 companies and one of them does really well, awesome. Like I benefited from that. One of them does really badly. Ah, bummer. But I still have 9 other companies that are less affected. Now the extrapolating that even more is like I want to own 2,000 companies. I want to own different countries worth of companies. Now I'm not going to own all of them, but I want to own portions of them, right?
Yeah.
And that's going to help me say, well, hey, did you hear about insert tech company that just had a bad day or a bad headline? Its stock prices to almost to zero, whatever. Like, awesome. I probably own a little bit of that,
Yeah.
but it's not affecting my entire investment path the same way having a ton of all your money or a lot of your money in one or two things that you've heard of is a lot riskier because
Yeah.
you just can't withstand a bad day, even if, yeah, it went up for a week or a month or a year and like went up a ton and you had a ton of growth. That's great, but I think it's just taking on more risk than you need to, which kind of segues into like the follow up of like, how do you own
Yeah.
2,000 companies, right?
Talk about an ETF or a mutual fund.
Yeah, and so there are these two ETF, exchange traded fund, mutual fund. Um, we don't refer to them as MFs because that has a different definition in popular.
MF does mean something else, not a
Um,
mutual fund.
um, but mutual funds came first, ETFs followed. We don't have to get into a full history of them. They're very similar things. A mutual
What
fund
sort of similar
is
things are they?
yes, a mutual fund is a well, both of them are a fund that owns a bunch of these companies. So I say, Vanguard, you have this one manager or you have programmed this one computer to track a lot of these companies and buy into all of them. And then you wrap that all up and say, this is the large tech companies of the United States in a fund. And then instead of having to buy a share of Amazon and a share of Tesla and a share of Apple and a share of Microsoft and a share of the list goes on, I can say, I'm going to buy a little bit of this fund that is holding all of these things. And instead of having to have, I mean, the $48,000 that it takes to buy one share of all those companies
Right.
or more, right? I can spend $50 and buy a share of that one fund that owns a little bit. So I'm having microscopic exposure to each of those companies and to that industry or that sector
Yeah.
rather than having to do that all myself. Um, and then there's a ton of mutual funds. There's a ton of ETFs. There's more funds than there are individual stocks. So
Really?
yeah, by a lot.
Whoa.
By like I think like 4 or 5 times as many. I don't know exactly, but
Wow.
I mean, you think about how many different combinations there are.
That's true.
Like there's a
Our,
ton.
it becomes exponential, right?
Right. But this is one of
And we're all
my
coming back
favorite.
to that.
Yeah, this is one of my favorite little facts.
Yeah.
Um, fact check required. Um,
Okay, so we've got so I want to get a little
mhm.
bit towards respectful of time.
Yeah, yeah.
Um, there are different types of investment accounts that I
Mhm.
want to talk about. There's 401k and IRA. There are just brokerage accounts where you can be buying these individual funds or individual stocks. Um, can you talk about the tax advantages of some of those and um, why we care about the difference between a 401k versus a Roth IRA versus a brokerage account?
Yeah, absolutely. And then I want to even take a little bit of a step backwards and say, like, how do you buy a stock? How do you buy into one of these
Yeah.
funds? And give like a little bit of a roadmap there. So if I like decide I want to start investing, like what does that look like? And then we can get into the tax advantages here. But what I would do is I would choose, I mean, we just talked about it for a couple of minutes, like one of these platforms, right? Vanguard, Fidelity, Schwab, Robinhood, Acorns. I'm so
Right.
sorry to the 240,000 other places that I'm
There's a
not
ton of
mentioning, right?
platforms. Yeah,
There's a
there's a
lot of
ton.
platforms, right? And they're all advertising to you all the time. And if you listen
Yeah.
to this, you'll probably start getting random, whatever. um, but I'm
This
gonna
is not a sponsored post. This is
no, no. But I'm gonna open an account with one of them, and then within that, so I'm gonna say like, hey Vanguard, I want to open an account, and then they'll say like, what kind of account do you want to open? And I can either open a IRA, which is an individual retirement account, or I can open a taxable brokerage account. Those are the two main ones. There's a ton more, but those are the most common ones, right?
yeah.
Some other terms you might hear is like an individual brokerage account or a joint brokerage account if you're married. Um, not super different between those two. So you can open up, one of those. Then I say I want to open up an individual retirement account. Then it's going to say, do you want this to be traditional individual retirement account or Roth individual retirement account? Roth IRA, traditional IRA. Those are both tax advantaged vehicles. So the reason those are tax advantaged vehicles is the United States government has said we require some taxes from you whenever you earn money, but we also want you to retire at some point. We think that's a good thing, think that's helpful, whatever. We're going to say you don't have to pay taxes on some portion of this money if you put it in this retirement vehicle. And so if you open a traditional retirement account, that is saying, I'm not paying taxes on this now. I'll invest it, it'll grow, and then I'll pay taxes on it when I take it out when I retire. A Roth IRA is going to be the flip side, which is saying, I'll pay taxes on it now, whatever, and then I'll put it in, and then it'll grow. I'll invest it, it'll grow, and I don't have to pay taxes on anything there when it comes out. Um, so those are both really cool things. They can really help you make the most of your growth. Um, Typically, an IRA doesn't like once you put the money in there, you can't take it out until you're 60 or 59 and a half. There's some certain stipulations there. And so like that locks it up long term, which feels a bit restrictive, but is really like helpful for some of this investor psychology we're talking about of saying
Yeah.
like I put money away, I can't access it, and then I'm like, well, it's 40 years, I'm gonna forget about it, and then
Yeah.
40 years later, you're like, wait, I actually was putting money in here regularly, and it's grown a lot.
And that's who you end up with, $1 million, a couple $1 million put away. Yeah.
And so then kind of the last little bit in here is like within that IRA or that Roth IRA or the traditional IRA that I've opened, then I can choose what I want to buy with those dollars. So then I've got my broker or my account with Vanguard, I think is our example. I opened an account with Vanguard, I opened a IRA, I opened this IRA, I put money into it, right? So I said from my checking account or from my paycheck, put $100 in here, whatever. Then logged in and I said in here, buy 1 share of this, 10 shares of that, 100 shares of this, whatever it is. And then I can set it and forget it. But those are kind of the
That
three
last step,
steps.
that last step is important. I think there's a lot of I've seen a lot of like TikToks and videos of people that were like, oh yeah, I was putting money into my 401k Roth IRA, whatever, for 2 years before I realized that it wasn't invested. It was
Cool.
just money in this account, and that's you want to make sure you've done
Hurts
that.
my heart.
Yeah.
um,
It's an important thing to just check and make sure.
yeah.
Um,
And,
okay,
and
so
then,
then, oh yeah,
sorry, a 401k is basically the same thing as an IRA, and in a lot of ways, there's often a Roth option, there's often a traditional option, which have the same, either you pay tax on it now or you pay tax on it later, but it's through your employer. So your employer sets that up. There's a few different nuances there, but they're really not super important. Um, and one really nice thing about a 401k, often an employer is required to match a certain percentage. And
yeah,
so if you hear about a 3% or a 4% match, um, and so it's like you're putting in 3% of your paycheck into that, and your employer is matching that and giving also 3%, which is 100% rate of return, which is awesome. We love that.
it's true. Yeah,
Um,
free money,
it's free
free money,
money,
right? Yeah.
right? And
Yeah,
so,
I mean, it really is like a 3% raise because that's
mhm,
your employee saying, or your employer saying, if you're putting 3% of your paycheck in, we'll match that and
mhm,
we'll double that 3% and
mhm,
we'll just pay the other half. Right.
yeah.
Um, okay. And then the other thing that you mentioned was brokerage accounts. What are the tax advantages of a brokerage account, Jesse?
So a brokerage account is interesting because
Okay.
it's not nearly as much, like it's not as restrictive, and so you can say maybe you want to put a down payment on a house in 7 years. A brokerage account is a really good place for that to go, because you're saying like, hey, put some money in here, I can take it out before I'm 60 without any penalties, without any consequences, whatever. um, One thing is, like, you do have to pay taxes on the gains of that money. So if you invest it and then it doubles in value, you take it out. So you put $100, you take out $200 after it's grown to 200. Well, 100 of that is going to be quote unquote taxable. Um, there's a couple different types here. We can put in some resources about, like, long term is taxed at a lower rate. So if you've held it for more
Oh
than a
yeah.
year, then it's taxed at a lower rate. If you've held it for under a year, it's taxed like your income. Um, Whatever you put in there is not going to be taxed. It's already been taxed when you put it,
Yeah.
like when you earned it. Um, and so that's why you don't want that to be your only retirement funding, because like you're typically paying a little bit more in taxes on it. But it's a great part of the toolbox. Like, I absolutely think it's a good thing to be investing, opening a brokerage account or a
Yeah.
taxable account.
Well, and if like thinking about the conversation that we've had today, and there's kind of three buckets of savings of investing that you've talked about, right? If we go back to the original definition of investing that we talked about at the top of this show, it's a key strategy to building long-term wealth and financial security.
Mhm.
That you talked about an emergency fund, like a savings that's just in your savings account. That's not invested anywhere, right? That's kind of your short-term
Yep.
safety, your
Yep.
short-term financial security. This brokerage account is maybe your mid-term
Yeah,
financial
absolutely.
security.
Yeah.
And then the retirement accounts like the IRA and the 401k, those are your long-term financial security. So they all have their
Hmm.
advantages, they have their place, but they just fill different roles so that you're able to build your financial well-being and financial security over you're able to hedge it over long term.
Yeah. Yeah. And so, I mean, we could legit have a 10-hour conversation on like the nuances here. And so we're not doing it full justice on the 6 minutes we devoted to it. There's
Yeah.
a ton of benefits to all three. The best benefit is like doing all three, right?
Yeah.
It's really not always like, not usually a conversation of like brokerage account or IRA. It's like, what do I want to do within here and what do I want to do within that? But like, it is helpful to have both depending
Yeah.
on your situation, depending on your circumstances, obviously.
I love it.
Yeah,
I love it.
yeah.
Well, Jesse, thanks for talking about this. This is not the last time that we'll talk about investing on this podcast. This is the last time that we'll talk about all of these topics, and we'll be bringing on more financial advisors, more financial planners, more wealth management specialists, and specialist may be a bad term there. I don't know. I may be making up job titles. But we'll be bringing in more people with this background to continue this conversation over the rest of the summer and over the rest of the year and beyond that. Like healthy, wealthy, and wise.
Hmm.
What's one of those? That's that middle one.
Wealthy, right?
Wealthy.
Yeah, yeah.
It's these conversations. So appreciate you kind of lending your
Hmm.
expertise and your
Hmm.
knowledge to this, and we'll have all sorts of resources in the description.
Yeah. Hopefully this cleared up a little bit of confusion. If you have specific questions, I mean, text us, right? Like, I'm
Totally.
happy to take a quick look. Happy to, lend a little bit of individual expertise depending on
Yeah.
capacity.
Yeah. And
um,
text us
yeah.
503-893-2664. We will respond. So appreciate it. Let's do this thing.
Right on.
Onward and upward.
Onward and upward.